Thank you guys for joining us for the weekly Self-Storage Investment Club meeting. I'm Brandon Robinson, your host and the one of the founders of the Self-Storage Investment Club. And the reason why we started this club is for situations like this, where we can bring in some top-notch, high-level individuals in self-storage, be they lenders, property managers, fundraisers, whoever it is, and just help out the general public who has an interest in self-storage and but may not have information. And it's been very the feedback that I'm getting since we started this in February has been very positive. A lot of folks getting a lot of good information from it. And we even have some individuals in the club who have become first-time buyers and have partnered with people here in the club. And as a matter of fact, next week, we won't be meeting on Wednesday the 8th. We will be meeting on Thursday, July 9th at 10 o'clock a.m., where I'll have three individuals that are first-time buyers of storage. And we're going to interview them and have them walk us through some of the ups and the downs and the pros and the cons that they face when buying their first storage unit. So you don't want to miss that. If you're someone that is looking to buy your first facility, it's always good to hear from individuals that have done so and that are in the position that were in the position that you're in. So we'll have Russell. He's going to be with us. Russell Miller will be with us. He purchased a facility that I sold him in Santa Maria called Off Broadway. We have Jose Ternicio. He'll be with us, him and his partner. They're first-time buyers of a storage in Montgomery, Alabama. And then we also will have Everett Jenkins, who he's a first-time buyer of a storage in New Mexico. But then recently, we helped him purchase his second facility in Hattiesburg, Mississippi. So you don't want to miss that. Join us, and that'll be next Thursday, 10 o'clock a.m. So with that being said, let me get to our feature today. So today we have Andy Graham of the Allison Company. And Andy Graham has been financing commercial real estate since 1985. Andy, that's a long time you've been doing that. throughout Southern California and nationally. Andy is versed in virtually all income property types, including apartments, industrial, retail, office, hotels, self-storage, mobile home parks, single tenant, triple net leases, and special purpose properties. He has extensive experience as a mortgage banker representing lenders ranging from life insurance companies, agency lenders, Wall Street CMBS lenders, banks, credit unions, savings institutions, and private funds. Andy has also worked as a direct loan officer at Bank of America, Union Bank, First National Bank of San Diego. Andy joined forces with the Allison Company in 2014 as a principal owner of Allison's San Diego office, and Andy graduated from the University of Wisconsin-Madison in 1983 with a Bachelor's of Science degree in Finance and Investment Banking. Go Badgers! So with that being said, I need you guys to help me welcome Mr. Andy Graham. Hey, Andy, man. Thanks for joining us.
That's quite an intro.
Go Badgers, huh?
Yeah. We're everywhere.
Right. So, Andy, one thing I didn't see in your bio was, you're an avid, you're a drummer, right? Or is that the only instrument you play, or do you play other instruments?
Just drums, yeah. All through school.
Oh, you did?
Yeah, including the Wisconsin marching band.
Okay. All right. Nice. So you were there at the football games, basketball games?
Every home game for 4 years.
Gotcha. Okay. And do you still play with your band out in St.
Yeah. Yeah, I play in a couple different bands around Southern California.
Right. What genre?
Rock and roll, 60s to current, and the more fun one right now is country band. Country is the new rock.
Yeah.
and I play in a country band that plays all over the place. So I do about 80 gigs a year.
Wow.
Yeah, it keeps me busy. It's fun. So I close. I'm an old
Yeah.
guy now, and I close bars.
Okay. Wow, man. So Everett Jenkins, you're a former Badger too.
There
Okay.
we go. See,
There
we're
we go.
everywhere.
Yeah, yeah, there you go. Cool, cool.
Right
Well,
on.
well, hey man, let's get into it, Andy. And as it relates to lending, man, how would you describe the lending environment right now? It seems a little bit like how would you describe it?
Actually, the it seems like the economy is a little bit right. Nobody knows where it's going.
Yeah.
The lending environment, though, there's plenty of money out there. Lenders are all trying to meet production, sometimes contrary to what borrowers feel, but lenders are always trying to put money out. They're under pressure to put money out, make new loans.
Yeah.
Um, and spreads are thin right now because they're not quite meeting their demands. So they're pricing as aggressively as they can.
Uh-huh.
Um, we were at lunch with the lender Monday and they only do under 50% loan to values, but they're pricing 3 million and above at as low as 100 to 110 basis points over treasury. And we'll get to that graph, but the treasury today is 447. So you put 100 on top of that's 547, 5.5.
Right. The requirement is that you have, with that particular bank, you have to be under 50% LTV. Is that?
Yes.
Oh, wow.
So there's always there's no perfect lender that's the highest loan amount, totally non-recourse, long fixed rate, no prepayment. So you sort of have to pick your poison, and that's kind of what we do as mortgage banker.
Right, right. So can you describe just the difference between, because we hear these terms, hey, mortgage banker or mortgage broker and lender. Like, what's the difference between what you do as a mortgage broker versus a direct lender that's an in-house lender?
Sure. There's a lot of direct lenders. Yeah, there's most lenders are direct. Banks, credit unions. I'd say half the life companies are direct, sort of.
Right.
Um, and you can call your bank and get financing. You can call multiple banks and get financing if you choose something. If you want to do all the groundwork, a mortgage broker basically is in the market every day, just like you are between buyers and sellers,
Right.
and knows who's hot and who's not hot. The term mortgage banker is from the old days, and actually is more a more formal arrangement between lenders where we actually have correspondent lenders that we service for.
Okay.
So some of our lenders, you can't just call, they don't want to do business direct. They don't want to
Okay.
fish through yes, they want the funnel sort of skinnied up a little bit by the time they see the deal. And so they'll only go through mortgage bankers. So there's certain life companies that want the deal screened first before they see them.
So I couldn't call the life company like MetLife. I couldn't call them and say, hey, I want a
Yes,
loan for the storage. I'd have to go through an individual like yourself that they have
some life companies you could wander through that. They will do direct, but many of them not. They would say call Allison Company or a
Okay.
competitor of ours.
Right.
Um, and we just help slim down what they have to, the information they need, the information they don't need, at least right away. So we sort of streamline the process.
I got you. Okay. All right. And,
And I
and
would
what's
say one more comment maybe is in years past, in let's say a couple decades and before, you would go to a mortgage banker because that was really the only source, the only way to get to a certain source for money. And that's less true now. There's more choices for financing and more institutions now probably than there ever have been.
okay.
And the good news about that is if you want to do the work as a borrower, you could call a whole bunch. The bad news is that's made the market really confusing to someone who's trying to figure out, do I call a bank? Do I need a credit union? Um, why wouldn't I get a life company? And so we, as a mortgage banker or broker, we sort of help the client sift through the choices to come up with what works for them. That's one thing. And then the other thing we really do is in the current day is the process. We help manage the process, and inevitably things come up which weren't expected or problems, and we've usually seen them before. We have multiple ways to solve those problems, financing, and so we
I
help with the confusing market and we help with the process.
I got you. Yeah. So you're like the guy who will come to you with a deal, and then instead of us dealing with the lender direct and just that one lender, you're pitching it to multiple different lenders across the board,
Yeah.
not just limiting it to just one lender.
Yep.
Okay. And you also are you're also like helping. You said you're helping as well. So you're like I guess giving some type of guidance to the borrower on, hey, this is what you can do to get approved for this loan or to make this deal appeal better to this particular lender. Is that
Yeah. I mean, we're completely the borrower's advocate. So
right?
maybe it's a good time to bring up that there's one that, not number two, but there's number one. We don't have to look at specifics, but we're generally, well, always actually, in our fiduciary duty to the client, we're indifferent to who they go with.
Okay.
Um, so, like this would be an example of what we put together for a client who was trying to finance something. This is an actual deal. I just sort of took the confidentiality out of it, but this is one life company, a bank, and a credit union. Life company had a few different choices, and these are all different. There's good and bad about each choice. And so we will send this to the borrower that they can look at the differences. We can talk about what they absolutely don't want, what they want. And then usually, and this starts usually kind of wide. And then as they slim down, like I really need a deal that has these features,
Right.
then we'll throw out the rest of them and maybe competitively bid about against two or three that are the most competitive in that area. So this is an example of us sort of
Yeah.
showing kind of the market to a client and then asking what works for them and what doesn't. And if you go to the bottom, if you scroll down there a little bit, you'll see sometimes we'll put in there like the decline. So, and the reason, a brief reason. So, they can see that it's gone out to 10 or 12 lenders, and some say no for different reasons. Some are still looking.
Right. Okay.
So we'll take their request, and here's what the lending market says about it.
Okay.
So
Yeah, so you basically you're giving them options uh
yep,
from different lenders as opposed to them going with one lender that only has one option for their loan product.
yeah, it's almost like well, I worked at a bank, and we had a loan program, and we got a tool bag that has one tool in it. So
Yeah.
I pull out the tool and it either works for you or it doesn't. But so we've got a tool bag that has, I don't know, it's unlimited, but usually 10 to 20 is kind of our initial screening. And really quickly we get down to five or so. And then
Right.
that's kind of how it works, who's competitive and depends on the terms. And so we'll send a client something like this that has obviously interest rate, when it's locked, how long it's fixed, what the payments would be, is it recourse or non-recourse, prepayment penalties, and then down on the bottom part is all what does it cost to
Yeah.
get one of these loans, and they differ widely depending on the kind of lender.
Yeah. So question for you. So you guys are the ones with the borrower, you guys will, I guess, receive all their documentation. You guys will be the one to run their credit and look at their assets. So they don't have to do that with every single lender that you're showing it to. They just do it one time with you, and then you then submit that package to all the different lenders, or are there multiple like
Yeah.
credit pulls and checks, or how does that work?
Yes. Although we don't collect everything we need up, like it'll, we up front, we sort of collect what we need to get to this stage here,
Yeah.
that you're looking at. We don't, there's no need to exercise. Like at this stage to get these, I would need we need stuff about the property, where it is, how big, uh, like a management summary and recent and historical operating statements.
Right.
We might need a financial statement from a borrower or just someone who says, hey, I own 4 properties and my net worth is 5 million.
Okay.
That would be enough to do this generally. Um, and then we get to this, and then as they pick a lender, then we would get more things like tax returns, credit
Right.
reports.
Okay.
We don't really do, there's no reason to do that or waste time on that until the borrower client says, I really want this deal. And the lender on the other side saying, yes, we want to make the loan. And then it's worth collecting all that data. We're trying to be efficient with the process.
Right. I got you. Is there any I mean, we see the good and the upside in having a mortgage broker that's submitting packages to multiple different lenders, giving you options. Is there any negative to going through a mortgage broker versus going to a direct lender?
Yes, a good question. Um, Maybe to a small degree cost.
Okay.
But most of the loan programs, if not like the vast majority, I don't know, 75, 80, 90%, have a wholesale program where it comes cheaper to us. Where, see, so we get paid on the fee. So somewhere in this kind of midway, you'll see loan fee.
Okay. Right here.
That's us.
Yep.
Usually it's
Okay.
us. Sometimes it includes a little bit that the lender will have. Um, but the lenders often, we most often deal with lenders that have wholesale loan programs, meaning it takes them more time to deal with a borrower directly, especially that's somewhat inexperienced, because they have to fish through all the data
Right.
that we kind of comb through and give them what they need when they need it versus here's my banker's box of stuff, right? So lenders will price cheaper to get deals that only fit their program, that have just the amount of information they need when they need it, versus educating a borrower on what they need and then actually having to collect it. And that's all the stuff that we do. Um, so
Okay.
we can be more expensive a little bit on fee sometimes, but most often we make that up in terms of finding a program the borrower wouldn't have found,
Right.
or it's the same price as it would be to them because we're wholesale and they're a retail price as far as fees.
That makes sense. You know what? That makes sense because it's similar to what I do as a real estate broker, where yeah, someone that owns a storage, they could go and sell a property themselves, put it on a website if they want, but they're going to be limited to in terms of how much exposure they get. Whereas
Correct.
you hire a broker, yeah, we'll charge whatever 2 to 6% of the purchase price, but we're going to show it to a wider net, and that's going to usually give you a higher price. So that's
Same
kind of,
thing.
yeah, I
Same
got you.
thing. I was gonna say something about that, but maybe it'll come to me.
It will. It comes to you. So I have one more question before we get to
Yeah.
the audience. You guys, audience questions. I have one more question because I'm on your e-blast, and every week, you're sending out stuff, and you send out a lot of stuff about the 10-year treasury, and what's the significance of the 10-year treasury to what you do in terms of getting financing for people? Like how,
Sure. Sure. So the 10-year U.S. Treasury is sort of a bench. It is like the biggest benchmark of where rates are. The
okay,
United States Treasuries are sort of the risk-free rate. Um, and so a lot of the market, corporate borrowing and real estate borrowing, follows the 10-year Treasury most as the number one that they follow. Even So it gives you an indication of where general level of rates are.
Okay.
Um, you know what I should have done is done a long history. I tracked a 10-year treasury every single day, put it in a spreadsheet that I keep, and then I can manipulate it to show clients whatever they want to see. And
Right.
this is something I've been using the last 6 months or so, that we've been in this range of 4 to 4.5 on the 10-year treasury for almost 18 months. And it's kind of interesting that, we're kind of going up and down. And when it gets near 4, that's great. And it's been between 4 and 4.5, strangely, just, if you go back through 2 or 3 years, it was below this graph completely. It was down in the 1 and 2s. But
Yeah, and that's why
so,
that's why the market was going crazy and pricing
right.
was high.
So many of the life insurance companies that generally do slightly larger deals, they price exactly off the 10-year treasury if you're getting a 10-year fix. So they'll,
Okay.
as I mentioned, the lender that was pricing it 100 basis points over, they would take this treasury rate when they lock rate and put 100 basis points on top, and that's the interest rate you get.
Okay.
Um, many banks and credit unions, at least half, don't price directly off treasuries. They just say, here's our rate. But in general, it follows the interest rate market pretty closely. So if the 10 years up 25 basis points, chances are your 5-year rate from the bank is also up, or the credit union. So the 10-year
Okay.
treasury is just the best benchmark in the market.
And how many? I know you said 100 basis points for one of these other the loan quote that you gave me. I guess what's the typical uh, interest rates that we'll see compared to the Treasury? Like, is it 100 or 150 basis points over what the 10-year is? 200? Like, what's that?
Yeah. So right now, and the market is, there's different strata. So like as you get smaller loans, pricing is a little higher, because if you think about it, borrowers don't often think about this, but they need to put out a certain amount of money every year in the hundreds of millions or even billions.
Right.
And if you're doing $1 million loans, that's a lot of transactions, a lot of salary, a lot of staff.
Yeah.
It's you can't get to 100 million doing $1 million loans all day. So
Right.
so some of the um, larger lenders will price more competitively, and usually off the 10-year treasury. So they'll be on loans 3 million and above is kind of a cutoff. We're seeing that 100 basis point lender up to maybe 200, depending, or high 100s like 180.
Okay.
um, on smaller loans, I'd say 175-ish to 250.
I
um,
gotcha. Okay.
is kind of so it really depends. If you need an $800,000 loan, that's a different animal than needing $5 million on a storage. So
Right. That makes sense because right now I think commercial mortgage rates are about 6.5%, right? Just from
six
right
and a
about.
half, 5.5 to 6.5, depends on how long you're fixed.
Yeah.
Depends on we can do loans from 3 years fixed to 25 years fixed.
Okay.
Um, so it just really, and it depends on what you're looking for. And often we have to marry that against prepayment penalties.
Right.
Most commercial lenders have some sort of prepayment penalty. So then the questions come: how long are you going to own it? Are you just fixing it up to flip it in a few years? Or is this like, I'm going to own it forever and pass it down to my kids? You have to, fit the loan versus the rate into those kind of questions.
I gotcha.
And that discussion happens usually while we're looking at those quote examples, where
Right.
you can go back and forth between these quotes and look at prepayment penalty versus rate versus cost and effective rate. And then you come up with an answer relatively quickly.
Yeah.
So that's kind of the process of finding the right loan.
Okay. Well, before I ask any more questions, I want to stop and see if there's anyone out there in the group that has any questions that you want to ask of Andy. What about general question about the market or Anything in specific about the loan products that he offers? No, you guys all shy. Everyone's shy today. All right, I'll ask you. So I know what question is probably on everyone's mind. Well, two questions that's on everyone's mind is what's your, I guess, what's your typical terms, down, loan to value and interest rate on standard self-storage deal nowadays. So something that's a like a $3 to $5 million deal. What do you guys, you know, what are you typically doing?
Let's see. Leverage is the big one. I mean, especially on purchases, right? So, and that's um, I would say, and the problem is it's not just a loan to value where you stamp 70% times your purchase price. Because I think one of your deal points are questions where how do lenders evaluate underwriting a loan? And probably the most important thing they're looking at is debt coverage ratio. So they're coming up with the NOI and
Yep.
they're measuring that against the payments for the loan. And I'd say the bare minimum these days, we're talking 120, 125 for a conventional lender, up to more like 150 and above for life insurance companies that are a little more conservative but have better rates.
Yeah. Are
So
they with that debt coverage ratio they're looking at, are they doing anything where they will lend based off projections? Like if it's a deal that's say struggling with occupancy, only 50-60% lease, will they look at the projection of getting it to a market occupancy rate or
to some degree, but they're not going to just because then they're gonna if you have really specific things that you can adjust that we can look into, they'll lean out a little bit, but they're not going to underwrite to a pro forma. Otherwise, people
okay.
just give them a.
Yeah.
And that's a difficult thing because equity buyers of real estate are looking forward and what they're going to change to the property to make
Right.
money. But lenders always looking backwards. What has it done? Like it's great that you think it's going to do X, but we don't know. And so they're looking, what has it done? And if you can justify, well, we won't have this expense and why, or here's where the market is on rents, we can get some benefit of that and they'll skinny the debt coverage a bit. But
Okay.
so
All right.
so I would say maybe going back to answer your question though, on we're seeing leverage mainly 60 to 70%,
For
maybe a
commercial.
little bit above that, up to 75 up for conventional lenders. So
Right.
that's kind of the market.
Okay. A couple questions in the chat. Adarsh is asking, what's the cap rate storage deals go for now, given the high interest rate and saturation of self-storage? Oh, that's
That's
probably
a
more of a
branding
question for
question.
me. Yeah, that's more of a question for me. So I would say depending on where you're at. So if you're in, depending on where you're at and also the asset type. So if you're in California in a major metro core market, like, you're in downtown LA or downtown San Diego, and it's a Class A facility, that type of stuff, I'm still seeing that type of stuff sell for 4 to 5% cap rates. And I mean,
Wow.
yeah, we've even sold some stuff at 4 to 5% cap rates just because it's very hard to replace and find those type of properties. And usually properties in those type of core markets that are Class A, you can push the rents a lot higher than you can if you're out in, say, Victorville or Adelanto, where the income is a lot less and there's more land for people to build storage. So if it's Class A in major metro, I'm still seeing stuff at 4 to 5%. If it is like Class B or C in tertiary, secondary markets and on the West Coast, we're seeing stuff between 5 to 6% that's trading. I actually have a client. They just recently bought a deal in Victorville and then one in San Jacinto for 6% cap rates.
I know that one.
Oh yeah. Yep. So you know Ryan Brown and Turnbull. You deal with those guys. Did you fund that
Yeah,
one?
actually, I'm an investor in it too.
Oh, you are. Okay.
Yeah.
Nice. Um, and then if you're out of state, so if you're doing stuff out of state, which a lot of stuff I buy is out in the south, in the southeast, you're buying the class A stuff out in the south and southeast. That's more 6% to 7% cap rate range. And then the class C and B stuff, more along the lines of an 8%, sometimes 9% cap rate. The only, the only way that we're seeing some deals out in the Southeast trade for less than that is if there's some type of seller financing or some type of value add. Um, so does that answer? Hopefully that answers your question, Adarsh. It really depends on the region where you're at, but typically West Coast stuff or major metro stuff, Class A is going for 5 to 6%. If it's Class B or C, Class A 4 to 5%, Class B and C 5 to 6, and then as you get into the South and Southeast, that's where those cap rates tend to go up a little bit, which is why we're seeing a big influx of investors buying deals in the Southeast. Like I
I think
can't,
the
you know,
trick is the difficult trick is to marry a cap rate that is at least the same, if not slightly above your loan rate.
yep,
And that way
yep.
you're getting more on your equity than just the cap rate. But that's difficult to do. It's not impossible, but that's
It,
the
it's
that's the
difficult. It's difficult on in the West Coast. If you're California, Arizona, Oregon, Nevada, that's very difficult, and you're typically buying the deal either at or right below, like your cap rate's going to be like right at or right below the interest rate on
the
your
loan rate.
mortgage, and then you have to rely on.
You want to do some value. You want to see some value add in the future. Otherwise, you're yeah.
Yeah, so it's tough. Wyatt is asking, interested, first time self-storage buyers can finance self-storage. Andy, do you guys work with first time buyers and SBA, or are you mainly working with more experienced buyers, conventional? Where are you guys?
We mainly do experience, but we have no nothing against working with first time buyers. We do some SBA loans. Um, we're not super versed in it, but we've done them and know them, and that has its own thing. And also that just SBA gives you leverage, but the
Yeah,
rates are generally
crazy.
higher
Yeah,
and harder to marry to the cap rate. So um, there are institutions that will lend to first time buyers. It's just there's less of them. I think I tell a lot of people that we start with the biggest pool lenders we can think of a deal. In fact, I have a list of lenders in my Rolodex, and when a new deal comes, I'll just scroll through every lender I have and kind of click the ones that are maybes. Then I end up with a pool. And then what happens is you start qualifying where is it, loan size, that pool starts shrinking down, and you end up, and uh, unfortunately for first time buyers, that pool is smaller, right? So we try to train borrowers that over time, or long term clients, how to become what lenders are seeking,
right.
the kind of borrowers, so that they have the biggest number of choices, right? Because if the larger pool of lenders you have choices, they all get competitive, and you can get really. So that's sort of the goal over time, is to turn into someone that lenders really want to lend to.
Yeah. And Wyatt, just in regards to the SBA, because I do a lot of those loans, the 504 and 7A, because I do a lot of work with first time buyers and smaller
Yeah.
mom and pops. The SBA rates, those are well, the 7A rate, that's typically tied to the prime rate.
Yes.
That's usually prime plus like 2 to 3%.
Yeah.
So right now the prime rate is at 6.5%. So your rate on the SBA 7A will likely be somewhere between like 8 to 9%, unless unless you're very strong, then maybe they can do like 1% over over the prime rate.
Right.
And then the
SBA has,
leverage is good. The leverage is great. Like you can get SBA 7A loans for like with 10%, 15% down.
correct.
You could even with the 7A, it's either the 7A or the 504. There's some that will allow you to use like a seller carry note as part of your, equity down payment. So you can get the seller to carry, say, 10%. You can put up five. Like I've seen people do that before. Were you gonna say, Andy?
Nope, you're right on the money.
The 504, if you do go SBA, the 504, that interest rate is it's a little lower, but it costs, I think there's more upfront costs with the 504.
Correct. That's
But
really, if you can do it, that's the one you want to.
yeah,
That usually has two first trustee and a second. So there's
right.
a bank that does 50% or so, and then the SBA issues a debenture, which is 20 years fixed. Right now, actually, I just asked yesterday, it's about 610 for 20 years, and that's for 35 to 40%, which add to the 50-year 85, 90% total leverage.
Yep.
So that's the 504 program, and that tends to be cheaper, but has a lot fewer lenders do that than the 7A, which is one deed of trust, and the
Yep.
SBA just guarantees a part of it.
Hmm.
Um, and those are usually priced over prime. So
Yeah. Let's see. Everett was asking, do you have any refi products for commercial loans? If so, what are the rates? You do refis, right, Andy?
yes,
Yeah.
lots of them. So the lenders we work with, almost all of them are indifferent to purchase versus refi. Like their
Yeah.
loan is their loan, and they'll underwrite to an amount and or maximum amount they can do, or whatever amount you request that's within their limits. And they don't care if you're purchasing it or refinancing it. And that actually one caveat would be if you're getting cash out. So if you have a $2 million loan and you've owned the property 10 or 15 years and you want a $4 million loan, some lenders, not a majority, some lenders don't like cash out. Um, and others are totally indifferent. So they'll do a $4 million loan, you pay off your $2 million loan and have an extra two to go.
Yeah. Yep. Yeah. So, and then with your refi, Andy, you guys are like, what's I guess a good loan to value for refi?
Same,
Same thing.
again, indifferent.
Okay.
So I will say when you're doing a lot of cash out, lenders don't want to push right up against their underwriting limits. They're kind of eyeing that up
Yeah.
because you're pulling equity out and many times all of your equity. But if you've owned it long enough, that's not a problem. I have multiple clients that that as time has gone on, they've owned it. They've got all their money out and then some,
Yeah.
but they're still a 60% loan to value or something like that.
Right. Yeah. All right. I'll take. Let's see. Adarsh. Yeah. Surprisingly, Adarsh, man, with storage, and I mean, I would say specifically California and major metro areas, the cap rates they're still very low. I mean, if you go out and try to get a deal, Class A deal, especially in San Diego market, LA market, which, there's a couple individuals here on the call that, they own and they buy in the San Diego and LA market, Orange County market. Class A storage in those areas are very hard to come by. So when you do have a deal come on the market, or even if it's off market, it's very, very competitive, and we're still seeing people offering those low cap rates between 4 to 5%.
One thing I might add is in the storage has benefited quite a lot in the last from institutional lending and equity in the last 25 years, 20,
Yeah.
25 years.
Yeah.
Prior to 2000, it was like the stepchild. Um, it was viewed as kind of a special purpose kind of bizarre mom and pop property,
Yeah.
and financing was harder to get. And what changed is in mid 2000s, maybe around 2010, as everybody knows, storage became much more institutionalized in terms of how it was managed, and people started paying attention to the yields. It was like a discovered product type, and in the lending market has also changed in that way, meaning like the lenders all got on board, and it's gone. Self storage has gone from a sort of, we'll look at a few if we have to, versus right up next to apartments. It's been
Yeah.
very
Yeah.
popular with many lenders, and it's benefited it because it gets really good pricing versus used to not get good pricing. Um, so there's a lot of lenders interested, and the market is very liquid. The lending market is very liquid for self storage. Um, so that's been helpful in the last 20 years a lot.
That's true. I've seen that as well. When I got started in 2007 in storage, there just wasn't as many institutional groups, wasn't as many brokers. Now it seems every one of these large brokerage companies has a brokerage group dedicated to storage. But when I started, most of the brokers, like myself, Dean Keller, Steve Grossman,
Yeah,
Clifford Crow, like some of the old school guys,
that was it.
yeah, like like we were all kind of uh, independent brokers because a lot of like storage really was under the radar for a lot of the big the big companies. But now every Marcus Millichap, CBRE, every one of them has multiple different brokerage groups that are dedicated to self-storage brokerage. It's
Yeah. I
yeah,
mean, we can do self-storage loans with Prudential Life Insurance and Northwestern Mutual, and big guys that 25 years ago wouldn't even, you
yeah,
know
yep.
there's
What-
still a few banks that everybody knows the names of that I won't name now, but they're like, we don't, they must have credit guys that just, they're still thinking old days and they will not do storage. It's like, really?
Yeah,
So
interesting. So, question for you is, what are the like, what's the different options that you have for like mom and pop first time buyer versus an institutional person? Because I assume that the type of loan product you would get them into would be a little bit different, or is
not necessarily, although mom and pop tends to be more banks and credit unions because of smaller markets and smaller loan size usually.
okay,
Um, but from a lender standpoint, they don't. Most of the loans we do, they're very property oriented. Where is it? What's the underwriting look like? Um, and who's running it? Do they have some experience? Um, but really, where is it, and what does it underwrite like? And
right,
that's above everything. So you could have a first time buyer buying the right one with professional management, and you'd have interested lenders.
okay,
Um, and that tombstone there is kind of interesting because some of those that ranges everywhere from
yeah.
CMBS to life insurance companies to and what's interesting, like the one in the bottom right corner,
Oh, I know that deal.
that's an RV park. And
I know exactly where that's at.
so there's a good example of a lot of lenders won't do it because it's a bunch of land,
Yeah,
right?
That's Santa Clarita, right? That one.
Yeah, you grade the gravel, and people, you
Yep.
charge people to park the RV, and you put a fence around with cameras. And a lot of lenders are like, there's no buildings. We're not. And but we found a really good program for that. Another one that was interesting on this is the $1 million one in the middle on the left.
Uh-huh.
There we go. That is almost entirely containers. So same kind of problem though, is they're not really buildings, they're not fixed real estate. So
Right.
there can be appraisal issues. Like a lot of appraisers will, it depends if they're sort of actually affixed to the ground or not, right? Because they bought trailers, set them down, and cut doors. But we found a loan that really worked for that buyer, especially against the purchase price, and from a life company that could see the light on that.
Wow.
So
Yeah, crazy. You got the life company did that size of a loan. Like I usually think
Yeah,
of life companies doing larger.
we did. There's several life companies, Standard Insurance, Symetra Life. We got a couple, United Farm. There are life companies that do smaller loans, down to say a million. Starts to get much harder under a million.
Right.
Um, but and then and life companies go up to 50 million or 100 million if you need, but we don't really play in that market very much.
Yeah. And
Our typical client has maybe two or three properties, um, to maybe 20, 25 properties, and they're an entrepreneur. They don't have in-house finance staff, or controller. Um, and they buy and sell or finance, maybe one a year or so. And they rely on us to sort of, um, help them when they're looking at a purchase. How could I finance this? Like that container storage, that was a purchase. I'm
yeah.
looking at this. The cap rate's great. We find a way to finance this?
Right.
Um, what was I going to say about that? Anyway, so that's, and the other
You
thing
solve
about it is
problems. It seems like you solve problems, Andy. Like you're
yeah,
not just, like if you go to a bank and they have their hey, these are our rules and our guidelines, but it seems like with you, it's like you look at
we're,
the puzzle and hey, how can I put
yeah,
this
we're very
together?
long term. So we like to keep clients for a while and solve their problems. I have a client we did worked on a $40 million one. We've probably done 15 million, and I did like a $300,000 loan for him because
Okay.
you got to help him with his, and we also will stay with a client like for the life of the loan. So if the lender's not doing what they want or being cranky or they don't understand something, call us anytime during that, 5 years later.
Right.
We still have the appraisals and the reports if you can't find it, or the lender wants this. Should I give it to them? Are they crazy? Or
Yeah.
we keep all the docs. They can call us and we look it up and we can help them out.
Okay. That's good. Daniel has a question here in the chat, so I'll read this to you. It says, do you source construction to mini perm loans for ground up RV and boat storage developments where the loan funds construction with interest only payments during the build out and lease up period?
Yes, there are such loan programs. There's fewer of them. Um, the ones I think of immediately are generally larger, say, again, around 3 to 4 million and up. We do have programs that are exactly like that from life companies that even will fix a rate up front. Like you'll lock in a rate and that's interest only during construction and it starts amortizing 30 years, 2 years later when you're done. Um, I'm trying to think of ones we have that are smaller. That gets a little harder when you get down to like a million or 1.5 million. That's much,
Yeah.
yeah, fewer choices.
Yeah, but if you're doing construction, it's probably going to be a lot more
It
than
should be more, yeah.
you're going to do a lot more.
Yeah, we do have that. And then it would just sort of depend on where, how rural, how not rural. A lot of lenders, it starts to get much more difficult to finance properties when you start getting under 50,000 ish, maybe down to 25. So as you get really rural, I'm talking about 5 mile
Population.
population.
Yeah.
Um, so that's why Los Angeles, right? If 5 mile population might be 400,000 people, it gets great cap rates and get great
Yeah.
pricing because there's so much demand. But you get to a small town of 8,000 people, somewhere in the Midwest, or that it's not impossible to finance. It's just you start with a pool of lenders that's much smaller, like 4 or 5 lenders, and you you get your best deals when you start with a pool of 50 lenders.
Right, exactly.
You're discarding the ones you don't like, right? Versus when you have a small pool of 4 lenders, you're
Yeah,
just
you're
looking for
begging.
anyone who says
Yeah,
yes.
a little desperate.
So we help with that process. That's our game.
Yeah. So what is I got last question, and then we'll see if the audience has any more. What I guess what storage deal or what type of storage deal are you most excited about financing in this present time? Like what's
Me
one?
personally,
Yes, yes.
well, there's two answers. The
Like one
easy
that's just
answer,
like it's like a no-brainer. When you see it, you
yeah,
see the deal, you see the person, you're like, oh, this is gonna. I got 50
those are
lenders.
fun.
Yes.
Although you can't say a no-brainer because those that's the quickest way to tank a deal, right? But
Okay.
no, low loan to values are fun because we can go out to lenders and make them bid against each other. So we can, what we like that as much as the borrower. So the lenders are coming at us and we're sort of saying, well, I got 10 basis points better over
Right.
here, and
Right.
I need prepayment flexibility, and and we're kind about it because we keep coming back to they rely on us for production. But those are fun because we can really tweak in the borrower's favor heavily. And then I'll
What's considered low loan to value for you? Like what's below
under
50%?
50,
Okay.
under
All right.
50, but we see a lot of 30, 35, 40, 45%. Somebody who's owned something a long while and they don't want any more money.
Right.
They just need to take their mortgage is coming due and they need to refinance it and they want a kick butt rate. Um, those are fun.
Okay.
On the opposite side, I'll say the part B is I like solving complex problems. So sometimes, you get a deal and you're like, wow, how are we going to do this? That container deal. I've done a couple container deals where I've even looked back and like, I don't know how we did this, but we got a loan on it. So
Yeah. All right.
the only thing to think about in those, and again, we think long term is borrowers should think about their exit point. So
Yeah.
just because you can get a lender to say yes right now, where's your loan to value going to be in 5 or 10 years when the loan comes due? How difficult might it be to finance based on whatever the property or loan to value, or so you want to, you know, just getting in is great, but you sort of want to think about what happens when this loan comes due.
Yeah.
What's it going to look like? Because you don't want to be trapped where you can't get financed and the lender can jam whatever terms they want down your throat. So we don't ever lead with that, but you want to think about that when you're getting a loan.
Yeah. Okay. I
So
appreciate it. Anyone else? Any other questions? While we got Andy with us? Andy, you mind if I put your information in the chat so if anyone
not at
wants to
all.
reach out? Okay.
And I do a newsletter, but it's not very often. I couldn't even keep up with Brandon's. This year's weekly or monthly. Monthly. I probably 2 to 5 times a year I'll put out an email with. Usually I have to have something to say, so something will strike me about interest, like this 4 to 4.5 range on treasuries, or will come. I'm about to do one on this 100 basis point lender that won't fit everybody, but some people might be looking, and it might be just so 4 or 5 or 6 times a year I'll put out an email that just says, "Here's what we're seeing." So anybody who wants to be on that, just email me and I'll put you on the list, and you can get off at any time you want, but it's not voluminous.
Yeah, he's Andy at AllisonMortgage.com. And I also have his address and number is in the
Ah,
chat.
I see John McGrath there.
Yeah. Yeah.
John's helping me.
Yeah. 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 That's good. Oh, see, we got some referrals and some positive reviews.
It's fun. It's a problem solving business. That's what I like, solving puzzles.
Yeah. Yeah. Well, I guess I can ask before we end, is there anyone out there at the present moment who's looking for a refinance on a well, not just storage, but on any type of property, or looking for a loan to purchase any type of property? So John, he knows, or Andy, he knows a lot about storage, but he also does apartments, multifamily, retail, industrial, triple net. Um,
Trying to think of what I haven't. I've done a funeral home.
A
Uh,
funeral home.
I've done a private hotel club. Um, I've done multiple hotels. Hotel in Yuma, that was hard. Um, you say Yuma and and it was like 15 million. So it's hard to get big lenders like
15
they're
million.
like Yuma.
Is that like the only hotel in Yuma, or
No, there's Yuma has a good hotel market. It's tight.
is
It
it
just took
people
a
that
while to,
is it people that are driving through Yuma and then making a stop on their way? Yeah, I could see that. Okay.
and agriculture and the Marine base. And strangely enough, um, a lot of people get dental work in Mexico. So they fly in from somewhere, stay in a hotel, go get their teeth done, come back to the hotel, and then fly out. It's
Okay.
weird.
Okay.
Yeah. So, we try to solve problems, try and figure out how to make a deal work.
Right. Gotcha. Okay. Everett, yeah, Everett, I'll send you Andy's information, or I'll start an email and I'll copy you guys both on that email so that way you can exchange contact and look at him for, refinancing Magdalena.
Yep. Think anybody can call. It's always free. We'll talk about anything and see if we can figure it out.
It's always free up to a certain time limit. Okay, don't call them and try to.
Actually, we could talk about that. It's free. Um, well, we have to close to get paid. So if we don't close, I don't
Yes.
get paid. So it's free. And that's rare. But they're not obligated until so what we'll do that whole process when we show the quotes, and the borrower will sort of pick a lender, will negotiate a application or term sheet.
Yeah.
And when they sign that, that's sort of when they become obligated to the lender and us, theoretically, assuming it closes. So that's when they'll put down a deposit, usually 1%.
Yeah.
Um, and they'll be obligated to some report costs. But we do a lot of the lender and us, we do all the work up front because we don't want to be taking applications that later that fall out. Nobody wants
Yeah.
that.
Yeah.
It's a waste of time. So by that time, it's like 95, 98, 99%. It's rare that we have fallouts once we sign an app.
Uh, what
Very
what's
rare.
what's
Like,
something I can cause? Oh, okay. I lied. I got another question now. When you talk,
okay,
it sparks new questions. So, what's something that a borrower can do that will hurt their chances of getting that loan once you've got to a certain point?
two answers to that. One
Okay.
is we're this is good. We're not the lender, so don't hide stuff from me.
Yeah.
Otherwise, when it surfaces, everybody's backpedaling and the deal will crater. So give
Yeah.
me all your dirty laundry. Let's figure it out. Because my job is to strategize with this issue. How do we slate it so that we get a yes? Right. I'm my only goal is to get a loan closed. So if I don't know about it and there's a problem that comes up, like, oh, well, we did have a bankruptcy 3 years ago, and I am finding that out after we've signed the application, that'll be a problem for everybody.
Yeah.
So we need to know all that stuff. Um, Whatever it is, like, the building burnt down, or I don't know. The other answer to that question is not so much what borrowers do, but sometimes things just happen, like you'll get a phase one and there's a problem nobody knew about.
Yeah.
Um,
Yeah.
and that and we've solved those problems usually and still got to get it closed. Sometimes you don't because the lender just won't take a certain environmental risk, which sometimes the borrower shouldn't want to take that anyway either.
All right.
So those kind of things, title issues, sometimes survey issues. We rarely have appraisal issues most of the time because we're looking at that so close up front.
Yeah.
Um, Appraisal's always coming in at our guest number or higher. Um, what else? I don't know. We try to solve as much of that risk up front so that once you sign that app and we're moving forward, you're like 99.5% probability. Or
Yeah.
yeah,
That's good.
it's usually things that we don't discover, like title stuff.
Right. An
Um,
easement or some type of some
yeah, something
tax
that
deed.
nobody knew.
Yeah.
And so if there's an inkling of a problem like that, bring it up front and let's talk about it so we can figure it out so that all the skids are greased. That's what we want.
Yeah. All right. Well, Andy, I appreciate your time. Can you tell us what's going to happen in the market? Where are interest rates going? Are we going to get back down to 3% so that way we can? What's going to happen?
Yeah, everybody, that's everybody's. If we could all, if any of us could know, we would not be doing real estate. We'd just play the market at our desk and be trillionaires. But
Yes.
um, my personal opinion is this is the new market. Rates are not going back to threes and fours anytime soon. Um, I think, well, that range is kind of where we've been. I say if the treasury's around four, you know, it's a good time. I'd say in the last 4 or 5 years, if treasuries drop 20 to, rates drop 20 to 50 basis points, that's sort of all you might ever expect. I'd be all over stuff at that point. But I don't, there's as much upside risk as down. So I don't know. Rates, the markets is where it is right now. That's kind of, you got to make deals at this level.
Man, we need the residential housing market to pick up because a
Pick
lot of
up.
yeah, a lot of what happens in storage, it's tied to
Yes.
residential housing. When people are buying and selling and moving from one in transition, like that's when our demand is the
Yeah, we need
highest.
the residential mortgage rates are what, mid six, around seven, high sixes, I think. I don't know even. But when that gets lower, right, it makes more,
Yeah,
we need that to pick up.
yeah. Because right now it's stagnant because no one.
Everybody's worried about inflation in the bond in the market, the rate markets. They're worried about inflation and the government borrowing a lot. It's been a worry forever, but it's keeps getting bigger.
Yeah, that doesn't go anywhere. It's not going anywhere.
Let's hope not, because if it gets to a point where it's really a problem, nobody knows what that looks like.
Yeah,
So
yeah. Okay. All right. Well, Andy,
thanks,
appreciate your
Brandon.
time. No problem. Appreciate your time, you guys. Please reach out to Andy if you're looking for any type of loan to purchase or refinance, storage, or any other product type.
Yeah,
Reach
thank you,
out.
everyone. Hopefully that was helpful.
Yeah. No, it was very helpful. And hey, guys, I'll stay on for a couple minutes if you guys have any questions or want to talk about deals. And
I
oh,
stay or
again,
go.
again, just want to remind you guys, so next week, we're not meeting Wednesday. We're meeting on Thursday, July 9th at 10 a.m. And we have a couple gentlemen that will be talking to us about their experience as a first-time buyer. So be sure to join us. And Andy, thanks, man.
Hey,
Appreciate your
man.
time.
Thank you very much.
All right, take care.
See ya.